Hi everyone. I'd like to now review the two practice problems. So you should have tried these on your own already, and now we're just going to look at the answers and give you an explanation on them. The first one is problem 1-18 on page 56 of your book. The following cost data pertain to the operations of Montgomery Department Store for the month of July. Below, the Avondale store is one of many stores owned and operated by the company. The apparel department is one of many departments at the Avondale store. The central warehouse serves all of the company's stores. So, what they would like us to do is break down some information. The first is, what is the total amount of the costs listed above that are direct costs of the apparel department? So, we want to go through the various items and look for those items that are directly related to the apparel department. So the cost of sales for the apparel department, the sales commission for the apparel department, and the manager's salary. Those are specifically part of the apparel department at the Avondale store. Now there's other costs there. So let's see where they would fall. What is the amount of costs listed above that are direct costs of the entire store? So in part 1, just the apparel department. In part 2, the entire store in Avondale. So that would include the cost of sales for the apparel department, because it's part of the Avondale store, the store manager's salary at the Avondale store, the apparel department sales commission, and the store's utilities. The apparel department manager's salary would be included, as well as the janitorial costs. So those are specifically part of the cost of that store. So you see how we're getting really detailed and defining the costs associated with specific areas, whether it be the apparel department or the entire store. Now in the last, what is the total amount of the apparel department's direct costs that are also variable costs with respect to total department sales? So remember, variable costs will increase as sales increase. Fixed costs don't change. So we're looking for items that are going to increase or decrease in the same direction as sales. So what kind of items in this problem would that be, would account for those items? The cost of sales. Remember, as more sales, you'll have more costs associated or inventory costs with those sales. Sales commission. As you have more sales, there's more commission. Less sales, less commission. So that will go in the same direction. But none of these other costs, especially with the apparel department, are considered variable. For instance, the manager's salary. When you hear salary, that's a fixed amount. So no matter how much in sales there will be, that manager is receiving that salary. Okay, so that's a great review item to test us on direct costs in specific areas, as well as variable costs versus versus fixed. Let's go to page 57 for problem 1-19. Here, we're given information about Todrick Company. That's the information is based on them selling 1,000 units of whatever they sell. We could say it's coffee cups, okay? So we need to prepare a couple different items here. The first is what was introduced in this chapter, a contribution format income statement. So let's take a look. Now remember, a contribution format is not a normal income statement. It first calculates contribution margin. And the way we calculate contribution margin is by taking sales minus variable expenses, not all expenses, but variable, those that will change as sales change. That will give us our contribution margin. Then from there, we subtract fixed expenses, those that do not change as sales go up or down. So, looking at the information presented on page 57, we would start with sales. We would then determine cost of goods sold. Now, how do we determine cost of goods sold? Remember what cost of goods sold is, and the name describes it. It's how much the company pays for any inventory that they've sold. So of those amount in sales, here's how much the company had to pay for those items. We find that by taking the cost of our beginning inventory, which is given, $20,000. We add to that the cost of purchases for this year. That will give us the cost of everything that could have been sold. There's only two legitimate things that could happen to our inventory. The first is we sell it or it goes away, and the second is it's still here. The items that are still here are ending inventory. So if we add our beginning inventory and our purchases and get a cost of everything we could have sold, $220,000, and there's still $7,000 left, then $213,000 is the cost associated with the items that were sold. So that's always going to be our first variable expense in a merchandiser, a company that sells its inventory, sells inventory. But there may be other variable costs that also need to be determined. And they're given here. Variable selling expenses. So those are things like your sales commission, maybe even advertising, depending. So these items will increase as sales increase or decrease as sales decrease. There's also an administrative expense component of variable, but it's not given to us. We have to figure that out. Okay, so let's see, how do we figure that out? Well, if we take sales okay, and well, this is proving it. Let's just stop right there, okay? Because you kind of have to work backwards there. So let's leave that blank for now, okay? Let's keep going. Pretend that's not there. Pretend the 240,000 isn't there, okay? The contribution margin can be determined. How? Well, we know our fixed costs. Our fixed, no, we don't, do we? we know our fixed administrative expense, $12,000. Okay, we need to fix out or determine our fixed selling expense. But here's the deal. They give us our contribution margin. So right now, if you go backwards, we take 300,000, we have 213, we have 15, and we have 60. Now, how do we get this to the 60? Contribution margin is always sales minus all of your variable expenses or costs. So you can work and say, okay, variable expenses have to total 240,000. So you can calculate that. Right now, we know there's 213, we know there's 15, so we need to determine how much more needs to be added to get to 240, and that would be $12,000. We also know our net operating income, that's given. So we know our contribution margin, we know our net operating income. If we subtract net operating income from contribution margin, that tells us how much our fixed expenses are. Why? Because you have to subtract fixed expenses from your contribution margin. So we're just, instead of determining net operating income, we're determining what are our total fixed expenses, 42,000. Well, we know 12,000 are administrative. So we need to account for 42, so the other 30,000 are selling expenses, fixed. So that's how you would determine those missing components. So now we have everything, and we did it through a contribution format income statement. This is not your normal income statement. Remember, managerial accounting, we don't follow GAAP. Kind of have our own set of rules here. Now, they also show you how to determine variable expenses this way if you wanted to follow it, and that's basically what we did. We said sales minus contribution margin gives us total variable costs. We know two of the variable costs, add them together, there's how we get our third. Same with the fixed expenses. We know our contribution is 60. We know our net operating income is 18. So the difference is how much our fixed expenses are or costs are. We know one of them is 12,000, so the other must be 30,000. So this is a great problem to really test your understanding of the contribution income statement. In the second part, they say, okay, now prepare a traditional format income statement. So that's what we're used to in GAAP from our accounting 101 class. That's where we take our sales minus our costs of goods sold to give us gross profit or margin. So this is an external income statement, one that would be given to decision makers that are outside of the company. We then would subtract selling and administrative expenses, but selling expenses, variable and fixed, would be added together and subtracted in that category, and administrative, variable and fixed, would be added together and subtracted as one administrative expense. So the contribution margin income statement or format income statement separates expenses by variable and fixed, where the traditional separates them by type, meaning selling or administrative. And then that would bring us to our net operating income, which in both cases is the same. It's just getting to it is a little different. In number 3, calculate the selling price per unit. Well, we know our selling price is $300,000. I'm sorry, our sales are $300,000. And that was when we sold 1,000 units. So if we divide those 1,000 units into 300,000, that gives us our selling price per unit, or per, we were saying coffee cups. That's a very expensive coffee cup, right? Part 4, it says calculate the variable cost per unit. Now remember, we need to use the total variable cost. So I'm going to shift back up here, and the total variable costs, 240,000. So when you sell 1,000 units, your variable cost is 240,000. So if you divide those 1,000 units into the 240,000, it's going to tell you how much each unit's variable cost is, and that's 240. So if we sell one more coffee cup, we'll have sales of 300,000 and we'll have variable costs of 240. That means our contribution margin per unit, or how much money we actually make per unit, is $60. The cost, the sales per unit, selling price, minus how much it costs, the variable cost associated with that unit, $60. So these are very important calculations in managerial accounting to help us manage the company's sales, inventory, and overall costs. So which income statement format would be more useful to managers in estimating how net operating income will change in response to changes in unit sales, and why? Well, obviously, it is the contribution format. It organizes costs based on their behavior, variable versus fixed. So it's very easy to calculate the impact a change in sales will have in not only the sales amount, but also the variable cost amount, as I just illustrated. Okay, so this is a great introduction into managerial accounting, where it's a little bit different of a focus, as you read in the prologue. So if you have any questions, please make sure you post them to the discussion board. And thank you.